Right now, as I'm speaking to you, the United States government is conducting an experiment that has never succeeded in human history. Not once. Not in Weimar Germany. Not in 1970s America. Not in Argentina, Turkey, or Zimbabwe. And yet, here we are on January 2026, watching it happen in real time. The price of money itself is being set by politics. And if you think that doesn't affect you, check your bank account in 6 months. Let me be crystal clear about what's happening right now. This isn't about Democrat versus Republican. This isn't about Trump versus his critics. This is about something far more fundamental, the integrity of price signals in a market economy. On January 15th, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve. The official reason? Cost overruns in renovating the EQ's building, the Fed's headquarters. But everyone in Washington knows what this really is the legal architecture to remove Jerome Powell before his term expires in May. Here's why this matters to your wallet. Under the Federal Reserve Act, a president can only fire a Fed chair for inefficiency, neglect of duty, or malfeasance. Policy disagreement doesn't qualify. But if you can manufacture evidence of misconduct, any misconduct, you've created your opening. The markets understood this immediately. Within 48 hours of the DOJ announcement, gold surged past $4,600 an ounce, setting a new record. The dollar weakened against the euro and yen. Bond traders began selling treasuries, not because they expected inflation, but because they expected the Fed would be forced to accommodate it. This is what financial analysts call the sell America trade. It's what happens when global investors decide that United States assets now carry a political risk premium. Let me repeat that phrase, political risk premium. This is terminology we use to reserve for Turkey, Argentina, and Venezuela. Now it applies to the United States of America. Why is this happening? The answer is brutally simple. President Trump faces the 2026 midterm elections. His political survival depends on making Americans feel like life is more affordable. Credit card debt has reached $1.23 trillion. The average APR sits at 21%. Mortgage rates were hovering around 7%. His voters are angry, and he needs a solution before November. On the other side stands Jerome Powell and the Federal Reserve, an institution designed since 1913 to be independent from political pressure. The entire purpose of the Fed is to make unpopular decisions, to raise rates when inflation runs hot, even if it costs elections. That firewall is now burning. On January 20th, 2026, exactly 1 year after his second inauguration, President Trump's credit card rate cap takes effect. The number is elegantly simple, 10%. No credit card in America can charge more than that. It sounds like a victory for ordinary Americans against Wall Street banks charging 25% or 30% interest, doesn't it? Let me show you why it's actually a catastrophe waiting to happen. Here's how credit card pricing actually works in practice. The base cost of funds for a bank is tied to the prime rate, which currently stands at 6.75%. A 10% cap leaves exactly 3.25 percentage points of margin. That margin has to cover multiple costs. First, credit losses. For prime borrowers with excellent credit, default rates might run 2% to 3%. For subprime borrowers with FICO scores below 660, default rates can exceed 10%. Second, operating costs. Customer service, fraud detection, transaction processing. These add another 2% to 3%. Third, reserve requirements. Banks must hold capital against these loans. Fourth, and this will surprise many people, those airline miles and cashback points you collect are subsidized by interest income from borrowers carrying balances. Do the math. A 10% cap doesn't work. It's not even close to viable. The American Bankers Association analyzed the numbers. Under a 10% cap, between 82% and 88% of all credit card accounts become unprofitable. Not marginally unprofitable. Deeply existentially unprofitable. What do banks do when an account costs them money? They close it. Here's the nightmare scenario that keeps me awake at night. There are 47 million Americans with subprime credit scores below 660. These people aren't going to stop needing credit. When your car breaks down and you need $800 for repairs, you don't have the luxury of waiting 6 months to save up. So where do they go when banks close their credit cards? Payday lenders, where effective APRs run 300% to 400%. Pawn shops, tighter loans that put their vehicles at risk. And in the worst cases, illegal loan sharks. The cruel irony is devastating. A policy designed to protect consumers from 25% interest rates will push millions of them into 400% interest rates, or worse, into the hands of people who break kneecaps instead of charging late fees. Dr. Samuel Gregg at the American Institute for Economic Research described it perfectly. We are creating credit deserts for the people who need credit most. And this isn't just Wall Street banks protecting their profits. America's credit unions, member-owned cooperatives that serve underserved communities, have come out strongly against this policy. In a letter to the president, they called it devastating. These aren't JP Morgan executives protecting bonuses. These are community institutions warning that they'll have to stop lending to their own members. Oh, and those airline miles you've been collecting? Those 2% cashback cards you use for everything? Gone. The rewards ecosystem is funded by cross-subsidies from borrowers paying high interest. When that interest disappears, so do your points. Every free flight, every hotel upgrade has been paid for by someone carrying a balance at 24% APR. Kill that revenue stream and the entire system collapses. The 10% cap creates a two-tier system. If you have excellent credit, you might keep your cards, but you lose your rewards. If you have average or poor credit, you lose access to credit cards entirely and be pushed into far more predatory lending arrangements. Why is this happening? The answer is brutally simple. President Trump faces the 2026 midterm elections. His political survival depends on making Americans feel like life is more affordable. Credit card debt has reached $1.23 trillion. The average APR sits at 21%. Mortgage rates were hovering around 7%. His voters are angry, and he needs a solution before November. On the other side stands Jerome Powell and the Federal Reserve, an institution designed since 1913 to be independent from political pressure. The entire purpose of the Fed is to make unpopular decisions, to raise rates when inflation runs hot, even if it costs elections. That firewall is now burning. Now let's talk about housing, where the administration is playing an even more dangerous game. On January 8, 2026, President Trump directed the Federal Housing Finance Agency to order Fannie Mae and Freddie Mac to spend $200 billion of their retained earnings buying mortgage-backed securities. The goal is straightforward: flood the market with buy-side demand, drive up bond prices, and push mortgage rates below 6%. It worked for about a week. Rates dipped below 6% for the first time in 3 years. Headlines celebrated. The president took a victory lap. But here's what those headlines didn't tell you. Fannie Mae's net worth as of Q3 2025 was $105.5 billion. Freddie Mac is smaller. Combined, these institutions, which backstop the entire American housing finance system, have roughly $170 billion to $180 billion in capital reserves. The president just ordered them to spend $200 billion. He's spending more than they have. Since the 2008 financial crisis, Fannie and Freddie have operated under strict capital requirements. The entire purpose was to build up a safety buffer so that if housing prices crash like they did in 2008, taxpayers wouldn't have to bail them out again. That buffer is being burned to buy votes in a midterm election. There's another casualty here. For years, conservative economists have pushed to privatize Fannie and Freddie to get them out of government conservatorship and into the private market. That dream is now dead. No private investor will put capital into institutions where the White House can commandeer their reserves on a whim. But here's the real trap, and this is where basic economics reveals the flaw in this entire strategy. Mortgage rates affect demand. When rates drop, more people can afford to buy homes. But what about supply? The United States housing market has a chronic shortage of inventory. We're millions of units short of what we need. And there's a phenomenon economists call the lock-in effect. Homeowners who bought in 2020 and 2021 with 3% mortgages aren't selling. Why would they? Why would anyone trade a 3% mortgage for a 6% one? They won't. So when you inject $200 billion of demand into a market with fixed supply, what happens? Economics 101. Prices go up. The affordability benefit of lower rates gets eaten by higher prices. You're not helping first-time buyers. You're helping existing homeowners get richer while pricing the next generation out entirely. Redfin economists estimate the rate drop could be 1/4 to 0.5%. The price increase could be substantially larger. It's a shell game. The administration gets the headline, rates below 6%, while the actual cost of buying a home continues to climb. This is the classic mistake of treating symptoms rather than causes. The real problem in American housing is supply. We need to build more homes. We need to reform zoning laws, We need to address construction costs and labor shortages. Instead, we're pumping money into demand while supply remains constrained. The result is predictable: asset price inflation in housing, increased wealth inequality between homeowners and renters, and first-time buyers who are no better off despite the lower rates. Now let's zoom out and talk about what happens when interest rates become a political variable rather than an economic one. We're currently at roughly 3% inflation. The Federal Reserve's target is 2%. Not catastrophic but sticky. The textbook response is to keep rates elevated until inflation cools back to target. But what if the president forces the Fed to cut? What if through legal pressure and public attacks, he gets his wish for cheap money? Here's what cheap money does to an economy. It keeps zombie companies alive. These are firms that can only survive because their debt servicing costs are artificially low. They're not creating value. They're not innovating. They're just existing, consuming capital that should flow to productive enterprises. In a healthy economy, when rates rise, weak companies fail. Resources get reallocated to stronger players. It's painful, but it's how capitalism renews itself. When you suppress rates for political reasons, you freeze this process. The zombies keep walking. The bubbles keep inflating. And when the correction finally comes, and it always comes, it's catastrophic instead of manageable. This is exactly what happened in the 1970s. President Nixon pressured Fed Chair Arthur Burns to keep rates low ahead of the 1972 election. Burns complied. Inflation exploded. It eventually took Paul Volcker and a brutal recession with 20% interest rates to finally kill it. We're walking the same path. The faces are different. The dynamics are identical. Let me describe what 2026 actually looks like based on current trajectory. Economists have a term for this: financial repression. It's a specific government strategy. Keep interest rates below the rate of inflation. Force savers to accept negative real returns. Effectively, it's a hidden tax on anyone holding cash or bonds. Right now, high-yield savings accounts are projected to fall to around 3.7% in 2026. If inflation stays at 3% or rises due to tariffs and additional spending, your real return is near zero, maybe negative. What does that force you to do? You have two choices. Either watch your savings erode or chase yield in riskier assets, stocks, crypto, real estate, assets that are already inflated by the same cheap money policies creating the problem. And here's the cynical part. This is actually beneficial for the government. The United States has $34 trillion in debt. If real interest rates go negative, that debt becomes easier to manage. You're effectively paying it down through inflation. The holders of that debt, pension funds, retirees, foreign governments, are the ones taking the loss. This is the classic mistake of treating symptoms rather than causes. The real problem in American housing is supply. We need to build more homes. We need to reform zoning laws. We need to address construction costs and labor shortages. Instead, we're pumping money into demand while supply remains constrained. The result is predictable: asset price inflation in housing, increased wealth inequality between homeowners and renters, and first-time buyers who are no better off despite the lower rates. This is the great repricing. Money itself is being repriced not by markets but by politics. So what do? How do you protect your wealth when the dollar itself becomes a political tool? I'm not a financial advisor. I can't tell you what to buy, but I can tell you how to think about this environment. First, understand that cash is no longer a safe haven. When rates are suppressed below inflation, holding cash is a guaranteed loss. The purchasing power melts away every year. This doesn't mean you shouldn't have emergency savings. You absolutely should. But recognize that money sitting in savings accounts is losing value in real terms. Second, hard assets matter more in this environment. Gold hit $4,600 for a reason. It's a hedge against currency debasement. Real estate, despite its problems, holds value when currency doesn't. The wealthy have always understood this principle. Now everyone needs to. Third, diversify geographically if possible. The Sell America trade isn't irrational. If United States institutional credibility is eroding, having some exposure outside the dollar makes sense. This doesn't mean abandoning US assets, but it does mean not having 100% of your wealth denominated in dollars. Fourth, reduce debt if you can. The 10% cap might feel like a gift if you're currently carrying a balance, but consider what happens when it expires in 2027. What happens when your 10% rate snaps back to 25%? If you're not prepared, you're trapped. Use this window to pay down balances while rates are artificially suppressed. Fifth, invest in your own skills and earning power. In an environment where financial assets are being manipulated, your ability to generate income becomes more valuable. Education, skills training, building a business, these are investments that can't be devalued by monetary policy. Sixth, be prepared for volatility. When price signals are overridden by political signals, markets become less predictable. Asset prices can swing wildly based on policy announcements, rather than fundamentals. This creates risk, but also opportunity for those who understand what's happening. Here's the bigger picture. We're living through a fundamental transformation of how money works in America. Price signals are being overwritten by political signals. The cost of credit, the value of homes, the stability of the currency, these are no longer determined primarily by markets. They're determined by whoever controls the levers of power. History has a word for economies that operate this way. They're called managed economies, and they tend to end badly. The question isn't whether the mistakes of the 1970s will be repeated. We're already repeating them. The question is whether we'll learn from them before the damage becomes irreversible. I want to be clear about something. This isn't about partisan politics. This is about the basic architecture of a market economy. When governments manipulate the price of money for political gain, they create distortions that compound over time. Those distortions eventually demand correction. The longer the distortions persist, the more severe the correction becomes. The policies being implemented right now, the 10% credit card cap, the $200 billion Fannie Mae intervention, the pressure on the Federal Reserve, these aren't isolated decisions. They're part of a broader shift toward treating monetary policy as a political tool rather than an economic one. You can't stop this, I can't stop this, but you can prepare for it. You can understand what's happening and position yourself accordingly. The credit card cap takes full effect this month. Watch what happens to credit availability over the next 6 months. Watch which consumers get cut off first. Watch where they turn for credit when banks close their accounts. The Fannie Mae spending continues through 2026. Watch mortgage rates versus home prices. Watch the spread between the two. Watch what happens to first-time home buyer affordability despite lower rates. The pressure on the Federal Reserve will intensify as we approach the midterms. Watch gold. Watch the dollar. Watch treasury yields. These are your early warning signals. We're in the early stages of this experiment. The full consequences won't be visible for months or years. But the trajectory is clear. When you politicize the price of money, you get political money. And political money serves political interests, not yours. I'm not optimistic about where this leads, but I am prepared. You should be too. The great repricing has begun. The only question is whether you'll be ready when it accelerates. I would like to hear what you think in the comments. Do well to like and subscribe for more updates.